The calendar says that it's late July, and we're moving, as always, seemingly too fast through the summer of 2024. Wall Street is very calendar focused as we follow quarterly corporate earnings reports and we analyze economic data that's reported monthly. Our video 1 month ago, A Tale of Two Markets, discussed the strong first half contribution from technology stocks and how market gains were relatively concentrated. Today we'll expand on that with several specifics from our mid-year market outlook. This includes 5 key topics. So we'll just get right into it. Number 1, we believe that the S&P 500 is either fairly valued or modestly overvalued at current levels. Primarily because investors are expecting a very positive trajectory for corporate earnings growth in both 2024 and 2025, this limits the potential for upside surprises. But at the same time, even flat returns could include improved relative performance from the average stock and participation from more sectors. Number 2, we see the potential for a market pullback or correction that on average happens every year. Going back to 1980, a period of 45 years, the S&P 500 in any calendar year saw a peak to trough decline of more than 14%. The largest S&P 500 drop in the first half of this year was just 5.5% in February. But already in the first 3 weeks of July, we saw the S&P 500 pull back more than 4%, and within the S&P 500, its leading sector, technology, dropped more than 8% over the second 2 weeks of the month. Perhaps a deeper retrenchment has begun, and it's at least a sign of more volatility. Number 3, consumer spending is slowing, but we don't see a recession in 2024. Slowing consumer spending trends in recent months include restaurants, automobiles, housing, and some retailers. And in addition, consumer credit or borrowing has increased. But this has been offset by continued jobs growth and gains in wages, contributing to second quarter economic or GDP growth that exceeded expectations. Slowing growth is okay and should still contribute positively to the economy, but expanding consumer weakness would create headwinds for many companies. Number 4, we think the Fed will look to cut its overnight Fed funds lending rate target in September, and that interest rates overall can move modestly lower in the second half of 2024. And then our last one, number 5, while the 2024 U.S. presidential election cycle had limited market impact in our view in the first half of the year, much has happened in late June and early July, and more surprises could be ahead. We would expect a period of increased volatility. What to do for investors? Well, stay invested. Earnings growth and economic growth is generally good for markets. And in line with recent comments from us, it's a great time to rebalance holdings within portfolios. Trim the gainers back to target weights and add to positions that have lagged. This allows you to be active while staying invested. And as always, for specific recommendations and strategies, please contact your D.A. Davidson financial professional.